morning. I'm Kim Martin, Head of Funding Strategy and Engagement at New Zealand Debt Management. First, I'd like to thank you for your interest in the New Zealand market. This week, New Zealand's half-year economic and fiscal update was released. Alongside this, we updated our borrowing programme, so I thought it was a good opportunity to provide you with an update on the outlook. As always, if you have any follow-up questions, please be in touch directly or drop me a note on the email address shown here. To provide you with some context for the changes to our borrowing programme, I'll first give a quick update on the economic and fiscal outlook, and then talk in a bit more detail about our funding strategy. Yesterday, September quarter GDP was released. Our real GDP fell 3.7% in the quarter, reflecting the impact to the economy on the period of increased restrictions across New Zealand as a result of the resurgence of COVID-19 in the community from August. However, the fall in GDP was actually less sharp than had been anticipated, as you can see by the yellow dot on this chart. And then GDP is expected to recover in the December quarter, helped by reduced economic restrictions as the COVID-19 vaccination rate in New Zealand has increased. So this map of New Zealand shows that around 90% of the eligible population in New Zealand has now received 2 doses of COVID-19 vaccinations. The darker areas on the map demonstrate where vaccination rates are highest. However, for now, international borders are still mostly closed to help limit the spread of the virus. Turning to inflation, CPI inflation forecasts have been revised upward right across the forecast period relative to budget forecasts. Supply side pressures have emerged rapidly since then. Inflation rose 4.9% year on year in the September quarter, and that's the largest rise in 10 years. Annual CPI inflation is now forecast to peak at 5.6% in the March quarter of 2022, and then it's forecast to decline towards the Reserve Bank's 2% target midpoint over the remainder of the forecast period. So unsurprisingly, in this context, the market is now pricing further rate hikes from the Reserve Bank. As you can see here, the Reserve Bank increased the official cash rate by 25 basis points to 0.75% in the November monetary policy statement. And the Reserve Bank expects to gradually remove monetary policy stimulus over time. So turning to the fiscal outlook, changes to the forecast for the operating balance, that's excluding gains and losses, are shown above. There's a stronger starting point at the fiscal year end for 2021, and the forecasts are also generally stronger, resulting in a return to a surplus in the 2023-24 fiscal year. So previously at budget, a surplus was not expected within the forecast period. In total, the core Crown residual cash position is expected to improve by 18 billion compared to the budget update. This is largely due to the same factors that impact on the operating balance. So this means that core Crown debt as a percentage of GDP is now forecast to peak around 40%, rather than at 48% that was shown at the budget update. Net core Crown debt falls to 30% of GDP by the end of the forecast period, and it's then projected to decline further. So that's the economic and fiscal outlook that forms the backdrop to the changes that New Zealand Debt Management has made alongside the half-year economic and fiscal update. So let's look in a bit more detail at the funding strategy. So forecasts for the New Zealand Government programme for the years to June 2025 have been reduced by a total of 31 billion relative to budget. The programme for this year to June 2022 is now forecast to be 20 billion, and that's a decrease of 10 billion relative to that was published at budget in May. The forecast programs for each of the years to June 2025 have decreased by 7 billion to 18 billion, and we've also added on an additional year to the forecast. That's the 2025-26 year, and that's set at 10 billion. Now this chart shows the steady trend of improving forecasts for the bond program since the budget in May 2020. You can see that forecast for the bond program in the year June 2026 is now back at the level similar to that that we had prior to the COVID-19 pandemic. The changes to the bond program are impacted by those material improvements in the fiscal outlook, but they've also been influenced by changes to the level of precautionary liquidity buffer that New Zealand Debt Management will be holding. This is illustrated, you can see here, by the black declining line. So a significant buffer was built up over the past 18 months. Firstly, as a precaution against the uncertainties of cash demands during the early stages of the pandemic, and then more recently as the result of a stronger than expected rebound in the fiscal outcomes. So now that the uncertainty in the outlook is reducing, we've undertaken detailed analysis on the appropriate size of the enduring buffer for the future. And our analysis suggests that a $15 billion buffer is an appropriate level to hold through time. This is higher than history, but it's below current levels. So our bond program is therefore set to allow for the gradual transition to this new level before June 2023. Given the decreased borrowing program, it's no longer expected that a second New Zealand government bond will be introduced via syndication in this current fiscal year. However, syndications remain our preferred method for introducing new bond lines. And you can see here a recent history of syndications. This is our current portfolio. At the half-year update, we also announced plans to begin a repurchase program of the 15 April 2023 maturity before the 30th of June 2022. This is standard practice for bonds approaching maturity. You can also see we've been building up volume via tenders into our most recent bond line. That's the May 2051 maturity, and we've been doing that after the blackout since the September syndication. Now this chart shows the history of inflation index bond issuance in New Zealand. In September, you may have noted we paused tendering IIBs for the remainder of 2021 while we consulted with the market on ways to build greater vibrancy in the IIB market. So following market feedback, at the half-year update, we announced 3 changes in relation to our IIB tender issuance strategy. So first, we will take a more flexible approach to issuance volumes. Our updates alongside the economic and fiscal updates will include a range of expected IIB issuance for the current year rather than a specific volume. Second, issuance will now be more flexible and responsive to changes in demand. Specific details of upcoming IIB tenders will no longer be published in the monthly bond tender schedule. Rather, we will conduct a survey of market participants to gauge demand for IIB. And then following that, we will announce when IIB tender issuance is to be offered. And then third, we intend to change from a multi-price to single price option mechanism for IIBs. And that will start from when we resume issuance, which will not be before March 2022. We could continue to see really good demand and diversity across our investor base. Our data shows that the proportion of holdings of New Zealand government bonds by investors outside of New Zealand has picked up in recent months to around 56%, as you can see here. The holdings of New Zealand government bonds by the Reserve Bank are now steady, as shown on this chart, since the bank's Monetary Policy Committee agreed to stop asset purchases under the LSAP program on the 14th of July this year. So, as you might expect, attention is now turned to the bank's intentions regarding its portfolio now that OCR hikes have begun. So the committee said it expects to gradually manage LSAP bond holdings down in a way that maintains the smooth functioning of financial markets. More details on how this will be managed will be provided early next year. So while this is a decision for the independent central bank, New Zealand Debt Management and the Reserve Bank have a public commitment to collaborate closely to ensure the efficient functioning of the New Zealand government bond market. New Zealand government bond yields have traded higher, influenced by moves in global peers and changing expectations for the official cash rate. The right-hand chart shows the New Zealand generic 10-year government bond yield in blue. Some peers are also shown in green, and the grey bars show current New Zealand 10-year yields hedged back to the domestic currency of the peer country. And finally, I'd like to touch on an important recent announcement from New Zealand Debt Management. In November, following a government announcement, we announced we are progressing work to support the first sovereign green bond issuance for New Zealand. Details of the bonds, which will form part of the overall New Zealand government bond programme, will be announced in mid-2022. The first issuance is expected in late 2022 via syndication. The programme aims to help ensure high-quality government projects with robust environmental outcomes are financed, delivered, monitored and reported on. And this is the latest in a line of initiatives undertaken by the New Zealand government supporting its wider environmental and social objectives, as outlined here. So once again, thank you so much for your interest in New Zealand. I wish you all the very best for the festive season and look forward to being in touch again in 2022. Thank you.